If you are in our greater podcast world, you may or may not know that I run another podcast called Money, Money, Money. On that podcast, we have embarked on doing a series of episodes, Money in Your 20s. So that whole episode is aimed at people in their 20s or late teens. Money in Your 30s. For that decade, Money in Your 40s. Now, on Retire Right, Martin and I, we actually are going to continue that theme and talk about money in your 50s, 60s and 70s. And it will be a really good resource for you. You know, if you are in your 50s, what are the key things that we need to consider? If you do have kids in their 20s, send them over the Money, Money, Money episode on Apple, Spotify, or YouTube, or 30s or 40s, all that stuff. I will say, if you are not in your 50s, and you are in your 60s or 70s or 40s, you will still learn from these episodes, but they have a particular slant to that decade in particular. So we are going to try and really hone in on that stuff. Martin, there are some fundamentals in every decade that we need to adhere by, right?
Yep. Yeah, I think it's two parts. Some of this concept that we're going to be discussing are applicable across all age brackets and can be used in all age brackets. We're going to highlight what are the key things you should be focusing on. But the fundamentals are, as part of this, we're not carrying bad debt. We're not carrying credit cards to try and put extra money into super. We're making sure that we've got some fundamental basics with our cash flow. We've got stable incomes. We've got our cash buffer or emergency buckets filled up. Those kind of elements
Yeah,
are
we've got a spending plan. We're spending less than we earn.
Yes, and continuing and hopefully being on the same page with your partner or other family circumstances, going through health situations. So there's a lot to cover off in all these areas. What we're trying to pull out of these is what are the top 5 things to focus on for this period of time. And there's various tangents will come off from that, I'm sure, as well.
Yeah. Now, we'll get into it right now, then we'll set up what we're going to do today. You ready, Martin?
Let's do it.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Okay, so before we get into this, I just want to thank everyone for watching what we're doing here on Retire Right on YouTube. Because it is part of the Money, Money, Money world, it sits on its own playlist in YouTube. So if you want to look on YouTube, you can actually go to YouTube and you can put search Retire Right. You can search Money, 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 Glen James. It will come up. Then you can click podcast and you can actually save just the Retire Right channel within that.
Yep.
Okay. We are predominantly still a podcast. And if you do listen on Apple or Spotify and you don't watch on YouTube, we will 100% acknowledge that you're out there driving to work or driving around, and we'll always do the best that we can to verbalize stuff for those who don't get to watch on YouTube. So part of that and us having the studio here now, and Martin and I have now got almost a standing fortnightly recording schedule where we just really want to make this as good as possible for our viewers and listeners. And part of that is, I've said to Martin, anything that you want to talk about, email me, we'll throw it in a presentation. And we've done that today.
And I think I saw in the Facebook group that people got to listen along and then actually went home the next day and watched it again. And so I think, what we're going to discuss, 90 to 95% of it's going to come across through audio.
Yep.
But that extra 5 or 10%, if you get the time, sit down and watch the video. And if you're watching now, well, that's a perfect place to start.
And we will put a link in the podcast show notes on Apple or Spotify to this YouTube channel. So I just wanted to end the housekeeping there just to kind of, thank you everyone for their grace while we get this tech sorted, and just some practicalities of what we're doing here as a business.
And you get to see our smiling faces.
Smile! It's the only problem, Martin, is I had to shave.
You got the hoodie's not on.
And all that.
The coffee stains have been cleaned up.
So what I'm going to do, let's get into this presentation. And even we are trying to be better. Like last presentation we did, you saw our mugs on it. It's just too hard, so we'll just be talking over that. So money in your 50s, you've kind of labelled this as laying the groundwork. What do you mean by that?
I often say that when you reach that 50 milestone, there's lots of milestones in life, but you're still far enough away from retirement to make significant impact. If life's been busy, you've been raising a kid, you've had different jobs, you've started your own business, you've had teenagers, all of the above, you have a big mortgage to cover, maybe super hasn't been your biggest focus or some of those finances, it's far enough away to still make a big impact, but also it's close enough to start to feel real.
But I will also say in this laying the groundwork, we'll say you're 55 and you're listening to this, there is a high chance that you may continue to work to age 70. A lot of people will work at least till age 67.
Yeah.
So we've still got 15 years to really, really plan stage 2 of our life.
Yeah. And even at that point, retirement and investing in superannuation doesn't finish the day you retire either. So it might be that I'm retiring at 65, but my super's going to be around for another 20 years beyond that. So if I'm in my 50s now, when I access my super, might be in 10 years, might be in 5 years, might be in 20, but also it's going to be there for the next 30, 40 years. And in many cases, passed on to the next generation, which will be part of what we talk about as well.
100%. Okay, here we go. What's your first point at school today? Oh, this is controversial.
I know.
Controversial.
We talk about laying the groundwork and the fundamentals, and often that's managing your debt, but we're going to kick it off with a bang, which is stop making extra payments on your mortgage.
Why? What if someone wants to pay their mortgage off?
Well, they can, and that's always fundamentally owning a home and
you
being
didn't know I was going to be aggressive
debt-free.
towards you today.
That's good.
Let's go.
And back to the groundwork. We want to make sure we've got a mortgage under control. We're making our repayments. We've got a buffer. Perhaps we're ahead in the redraw. But if we've got a bit of surplus income and maybe we were paying higher interest rates have gone down and maybe we're paying more than we need to, maybe we've decided to, geez, if I pay this off by 65, I need to pay this per month and therefore I'm stretching my budget that way. Good fundamentals and great to focus on. But again, back to that horizon of super might be on the radar at 60, we then have to look at some calculations and fundamentals, and luckily we've prepared some earlier, which we'll take through now, but have a look at that. If I'm going to pay money off my mortgage, I'm talking about extra repayments. So the bank's saying your minimum per week is $1,000 and you're currently paying $2,000, well then you're paying extra above the minimum.
Yeah.
We need to keep the minimum. We need to make sure the bank's happy. It's a question of that extra, whether that's $50 extra a week or $500 extra a week, is that better off the mortgage or perhaps might that be better somewhere else? And that is clearing credit card, clearing other bad debt, maybe clearing a car loan. But also now maybe starting to put some of that into super might start to make some sense.
Okay. So you mentioned here compare after-tax mortgage rates with super returns and tax advantages. And then I might just put this sorry guys, we'll go back here. So super grows in a tax-friendly environment with compounding over time. So all that to say, you could be paying 5% on your mortgage in after-tax money.
Yep.
But you could be investing that money into your super account that could earn 8-9%.
Yeah,
and you get that extra spread.
Yeah. So I think there's a few parts to this, but one of that is what's your mortgage repayment versus what your super historically has been getting. There's no guarantee of future returns, but historically there might be a margin there. But where the real superpower, I suppose, comes into the tax advantages.
Right.
Of that, if I want to pay $100 off my mortgage, I probably need to earn $150 or $130, pay the tax office to then get those after-tax dollars to pay off my home loan, whereas I can often send those pre-tax dollars into super. Therefore, there's actually more in the pot.
Yeah.
And so $100, if I'm at the average tax rate, if I earn $100, I end up with about $65 in my bank account. If I send that $100 to my super fund's probably going to end up with $85.
Right.
And so there's a margin there. Before we even worry about it, is the return high? There's already a margin there. So we're already
paying
ahead.
less tax.
We're paying less tax.
Yeah. Okay. Let's have a look at these numbers that you put together. Talk us through this to someone who might be listening as well. You've got some projections here.
Done some fairly simple projections just in Excel. We've got some fancy software we can use when we need to. But let's say today I'm 50, or I'm single or a couple, I'm 50. My mortgage is around $320,000. And I might be paying $1,500 a fortnight off that mortgage.
Yeah.
So it's about $39,000 a year off that mortgage. If I keep doing that at a 5% interest rate, and there's a lot of assumptions here, but that's hopefully a simple assumption to use, that mortgage is going to be paid off in about 10 years. So that's a $320,000 mortgage, paying $1,500 a fortnight or about $40,000 a year. It's going to be paid off in 10 years. That's good, giving the peace of mind that I'll be debt-free in 10 years. That's a nice, strong position to be in.
So you've assumed two people at age 50 in year one, they're paying, and again, to be clear, an extra $500 per fortnight or $250 per week onto their mortgage.
Onto the mortgage. So, yeah, I've assumed the minimum here is $1,000 a fortnight, and that'll show up in a second, but they're committed to paying $1,500 a fortnight, and coincidentally, that gets them basically paying that off pretty much bang on the 10-year mark, or a little bit into year 11.
Which the mortgage
months.
at age 50 is $320,000 to start with. Okay, cool. So you're saying, and if we go to the next slide,
so let's say
there's a lot to work through here.
There's a bit of numbers here, but let's just go back to those fundamentals. They're paying above the minimum. You may have the option to say to the bank, hey, I actually want to drop that to the minimum. Now, in this case, I'm saying the minimum's $1,000 a fortnight or $26,000 a year. So that frees up around $13,000 a year or $500 a fortnight of after-tax extra money. Now, that could be used to go on a big holiday, as I said, pay off some credit card debt, pay on a car loan. But what I'm saying here is perhaps that $500 a fortnight is actually used to put into super. But instead of just putting it directly into super personally, I'm saying let's contact payroll at work. This might be a couple does half each. It might be that a single person, they do the whole 500 themselves. And the way that's worked, and luckily I've done the numbers for us, but basically is $500 a fortnight based upon an average salary. I'm talking about someone earning between $45,000 and $135,000. You're at the 32% tax bracket there. That equates to $735 before tax. So we're talking about $735 a fortnight before tax gives you around $500 a fortnight.
Cool.
So if you say to work, I don't want that $500 a fortnight, send that to super, they would actually send $735 a fortnight into super. That's about $18,500, $19,000 a year, but your super fund has to pay 15% tax on that. So your net result is the super fund would get around $16,244 in that year. So before we talk through all the numbers on the page, then we're going, I can keep it personally, I end up with about $13,000, or I send it to my super fund, I end up with a bit over $16,000.
And, at the start when I said, well, what if you don't want to pay down the mortgage? That's fine, but based on even these numbers, you can see at the end by year 11 when they turn 60, they are better off.
Yeah.
Based on these assumptions.
So in year one, your mortgage wouldn't have gone down as fast. So instead of the end of the year with about $300,000, you'd be at $310,000, but you've got about $17,000 in super. So in year one, you're around $4,000 better off. We do that year on year and compound, and we've assumed the super fund's earning around 5%.
Which is conservative-ish.
It's fair, yeah. And we want to try to not muddy the waters too much of going, well, your super fund might earn 9 and your interest rate might be 4. Well, that would make these numbers better. But let's say they're earning the exact same return. It's really just showing there the power of that tax saving over time.
The tax strategy.
The tax strategy stands on its own 2 feet before the investment strategy. What that means on the middle section of the chart is that if we drop our mortgage repayments to the minimum, it's not going to be paid off in 10 years' time. Your loan balance is still going to be around $177,000. Well, geez, I want it to be debt-free. My mortgage, you're telling me, Martin, my mortgage is going to be $170,000. But when you look at your super statement, you're going to have $242,000 in there. the net difference there being around 64,000.
And you've assumed at age 50 that there's no super balance for this scenario.
Yeah. Keeping this simple is we're starting with no super at all. I'm ignoring whatever SG might go in from your employer. So there's going to be more moving parts, but without trying to blur it too much. But yeah, exactly. So ignoring your other super, ignoring what your work might be putting in already. I'm ignoring, do you have carry forward to use and what your limit, all that kind of stuff, which is, again, that's the detail to be important about. But talking about the overall strategy, the idea, you can see there that we still have a pathway to getting the mortgage cleared because at 60, the door to super starts to open. But the net result is if we could click our fingers at 60, we pull the 170 out, pay the mortgage off, we're still going to have 60 to 65,000 left over.
But the kicker in this scenario is if someone is planning to work until 65, they can't use the super balance until they stop work and retire. So it would mean they are actually knowingly carrying a higher mortgage until they tools down. It could be age 60, tools down, pay off the mortgage. Age 65, pay the mortgage off anyway, even if you don't want tools down, because you can get as much as you want out of super at age 65.
So it might mean the mortgage takes exactly 11 or 12 or 13 years instead of just the 10, but the net result is you could be, because I've just finished this at year 10 or 11, but if we go to year 15, you might be, instead of 60 grand better off, 80 or 90 grand better off. And then, there's other moving parts of, can you take it out at 60? Perhaps not. But what you can at 60 is you can start a transition to retirement pension. If you already had 500 in super, your balance might be 800. You might be able to take out a 10% TTR payment.
And pay off some of the mortgage.
Pay it off anyway that way.
Yeah. Just finally on these numbers, on this basic strategy, someone would end with $64,000 more.
Yep.
So that's compelling enough to have my attention. So we'll move on to the next slide in a moment because it is around super still, and that's topping up concessional contributions. But just on this, whether we pay the mortgage off, keep it on the minimum, this is where the value of financial advice comes into play. And when people say, oh, Glen, I'm not paying $7,000 for financial advice or $6,000 or $5,000, that's fine. You just need to be able to do these numbers yourself.
Yeah.
Because financial advice isn't about what's the best investment return. It's honestly 90% is strategy and optimizing. So a couple of things that if you want to talk to your financial advisor about, some considerations. If you're in your 50s and you've still got kids, maybe you're like, they might be in private school. Once they finish private school, we're going to not enjoy that 10, 13 grand a year or whatever, and we're just going to keep the status quo and salary sacrifice that to super. That could be a consideration. Talk with your advisor about that. I want you to also talk to your advisor to really turn this strategy up, and Martin, you'll be able to correct me more than me correcting myself. If you did turn it up to 11 and put the mortgage on interest only, and, so we're putting as much capital into super. Now, interest only might mean you pay a little bit of higher interest rate, but you're getting more capital into super, and that's going to be contingent on your concessional contribution cap, where you're at, all the moving parts.
Yep.
Another thing that you would get your advisor to do is if you had, for example, this same scenario, 320 grand mortgage, but it was actually $400,000, but you had $80,000 in an offset account, for example. Do we just take that and put it in? So all these things, an advisor would be able to do that and give you at least the next 10 years conservatively. We believe this is more appropriate if you do it this way.
Yeah, great. Yeah. And that's definitely supercharging, and we've done that with certain clients, and as long as they're aware of that, hold on, you're telling me my mortgage going up the next year? Well, yeah, it is, but you're going to save 30% margin on the money you move in. Yeah. You're not paying 30% on your mortgage. Yeah. So And that aggressive or that accelerator element may be more relevant at 58, 59 than it is at 51 or 52, but it's definitely there on the table. And some of those limits or some of those catch-ups, maybe a user will lose it if you're reaching the 500 threshold or they're expiring. So that's the personal advice bit.
And another thing that
relevant.
isn't in your slide deck, I don't think I saw it. If you are over 55 and the kids have left the house, can we make that change and do the downsize and make the shuffle then? That's another consideration.
Yep.
So, all right. So let's now go top up concessional contributions.
So somewhat connecting to that last strategy, but again, back to that, filling in the gaps of that. So step one of that is stop the mortgage repayments. Well, what do I do with that then? Is you go and make concessional contributions. So concessional contributions are putting money into super that you're saving on tax. Salary sacrifice or a personal concessional you do after tax, or you've sold a rental property and you want to put some money in to reduce the capital gains tax, a concessional contribution. And again, often in your 50s, that's the point where you're like, well, I'm starting to get some cash flow surplus that I perhaps have not had for a long period of time. It's then around, okay, is it better off the mortgage? Is it better in a savings account? Again, depending on your tax rate or your tax structure, but on the basis that money going into super is only taxed at 15%. If you're earning more than around $22,000 a year, you're going to be at a higher tax bracket than 15%. So obviously upped all the way to a 47% tax bracket. So if you've got the cash flow availability, even if you don't have a mortgage, I'm fortunate enough at 54 I don't have a mortgage, well then that last strategy might not be relevant to you, but this part of it is, well, don't start saving and investing in your own name. Perhaps it's start to move it into super in a tax efficient manner. Cap at the moment per year is $30,000. That includes what work puts in on your behalf, but there is those bring forward, carry forward, unused caps that you can use, which is if in the last few years you haven't maximised your cap, you can perhaps do more than that $30,000.
Just to comment, Martin, on the strategy of, obviously the topping up the contributions and putting the mortgage on minimum payments, and going down this road. For the DIYers out there, if you will, or someone who wants to, I don't want to pay for advice, I'll just work this out myself. And we end up seeing them post in the Facebook group saying they stuffed it and they've lost money because of that. All that to say, you could, in theory, depending what your mortgage is, and just go with me here, everyone, if you do have the offset account, generally when you have an offset account on the mortgage, the minimum payment would be taken from that offset amount each month, right?
Yep.
For your own sanity, your own peace of mind, what you might decide to do is kind of end up in Rome, like we're talking about now, but at the end of each year in June, make a judgment call. So instead of salary sacrificing the difference fortnightly,
you wait till the end of the year.
End of June. Okay, what's happened this year? We thought Rob needed his knee operated. He doesn't. There's an extra 30 grand in here. We've both got 15 grand free. We'll do that manually at the end of every financial year. Knowing that during the financial year we've offset the interest, but then next year we'll start to pay a little bit more interest, but that money will go to work in super. So there is a manual component that you can do this strategy. Do I recommend or suggest that? I would probably say maybe if you're self-employed, because it just gives you that little bit more extra control, because business owners sometimes you're like, oh, we don't know what's going to end up here, blah, blah, blah.
Or not.
So in June we can do some tax planning. If you're an employee, both employees, and you want to talk to your advisor and do this strategy, I think there is a compelling case to do salary sacrifice automatically.
Either or both. If you're doing it the same.
We both end up in Rome.
The problem often is you may not miss that salary sacrifice that's going in, or that pay review. This year, well done, you're going to get a $5,000 pay rise. I'm not going to take it as wages this year. Salary sacrifice that I survived last year on that net income, so therefore I'm not going to miss it, whereas sometimes it disappears from that offset account for different reasons.
Grows legs, if you will.
Oh, I deserved that weekend away. We paid for this. We upgraded that.
Yeah.
It's not there to save the tax.
What do you mean by point 3, ensure investments align with your preferences?
So within your super, and again, we're talking about previously super as a tax structure. Within your super, there are different investment choices that people think, oh, well, how does super return versus shares? Well, they're not the opposite. In fact, they're the same. Often there's shares in your super fund. So within your super fund, no matter what fund you're in, there are choices about what investments you can have, whether that's in the balanced fund, the conservative, the growth, the high growth. And the stat that I've kind of seen in different articles effectively that around 75% of people are in their fund's default option, which is yourself or your employers set you up with Fund A, and rather than not putting you in any option, they put you into what's called the default option, and that may be what you want or need, but it may not. And the fact that 3/4 of people haven't ever changed from that, either it's being done perfectly and everyone's magically in the right option they should be in, or I think the majority of those people have never even had a look. I don't know what I'm in. I'm just in whatever I was put in. So not saying it's right, definitely not saying it's wrong, but it's about making sure that perhaps it aligns to what your wishes are. It's important to, if you are going to change or rebalance, that you are proactive with that, not reactive of going, oh, I saw some headlines about my super fund, now do I log on and change it? Perhaps not. Or, hey, now I'm about to retire next year, is now the right time to change it? Perhaps not.
Yeah, what do you mean rebalancing now can avoid nasty surprises later?
I think it's around, I suppose, and that often people are reactive with that change. Oh, geez, I saw some headlines. I'm now going to go and make that change. That may or may not be the right time to make that change. There was an episode a few weeks ago about wrap accounts versus super funds. There's different tax implications of changing at certain points, pre-retirement or post-retirement. The other part on that, and connecting a little bit back to one about the mortgage, again, not personal advice, but sometimes in that strategy, when we've done that mortgage strategy, putting those extra salary sacrifice, we may not put them into the default growth option. No, if we know that, hey, we're going to rip 200 or 300 grand out in 2 or 3 years' time, we may send them to their own separate, isolated, more conservative option. So your long-term super's going in your main bucket's going to be there for a while, but your extra salary sacrifice into a separate investment option.
Okay. So practical, your main long-term wealth accumulation for retirement, food and drink and living expenses, that may stay in an 80% growth portfolio or 70-30, 70% growth, 30% defensive. But you set up another, either depending on the product, super fund or investment
mix within
that. So you say, okay, for the comfort level, because it's primarily a tax strategy, isn't it?
Yeah, and that's why even that projection, I didn't use a more balanced or growth return of 7 or 8% we'd expect.
Yeah.
I wanted to show that it's a tax strategy, even if we're not taking a high risk to get there.
And so you might go, all right, for the money that we salary sacrifice that we were paying on the mortgage, we're setting up into a separate super fund with 50% growth, 50% defensive. It's a very balanced fund. It's not as aggressive, and that gives us some psychological comfort.
Yep.
Because we know that we will be drawing that pot of money out.
And it takes away that risk of, we're lining this up that at 60 or at 65 or at 62, we're going to rip this 200 grand out. If a month before something happens economically in the globe, you go, geez, now I don't want to rip it out. If you've got that in, again, even we go, lots of super funds have a cash-only option or a bonds and fixed interest term deposit-like option, which has got little to no exposure to the market. Therefore, if you go, well, I like the safety net of knowing I'm saving this interest, we'll just have it in your super fund in an interest-only account that's, again, not saying for all your super, but for that strategy in particular.
Oh, like a cash investment option.
If you really want to be that conservative and go, well, it was saving myself cash.
That's the circular logic. If you're 50 years old and you want to do that strategy, well, once the money goes in, you can't withdraw it for at least 10 years. Why are we investing in anything but 70%? But I get... And that's why we need to educate people to bring them up. It's like, okay, Glen's arrogant comment there was it needs to be 80 or 70%, but let's understand that, well, we actually can't touch it for 10 years, so we'll put in a 50-50.
Yeah. Yeah, and that's where that's personalised, because I'd push back the other way of going, well, if I'm already saving 17% tax or 32% tax.
Yeah, we're already ahead.
I'm so far ahead. Do I really need the extra 2 or 3% a year? I mean, have your cake and eat it too, ideally.
Yeah.
But often a lot of people go, well, I'm not going to do that mortgage strategy because I'm too worried about my share portfolio, my super fund investments. Then let's take it one step at a time.
But I guess the risk, pushing back on your pushback, if I may, you really want to be having a return higher than inflation.
Yeah.
So if there is a chance that the capital could go backwards on paper when we look at inflation, even though we're a tax positive
strategy.
Yeah.
And it's different at 51 maybe than 59.
Yes.
And even within that, perhaps that is also changed along the way, because you can do that in various ways, which is, and back to this aligning investments, you can go on and switch your current holdings, or you can redirect future holdings.
Yes.
So it might be that I'll leave it in the default, but my future contributions, as you said, 50% go to the growth and 50% go to the cash. And then at some point I go, well, maybe only 20% go to the growth and 80% go to the cash, because my mortgage is down to 140 and my cash or defensive bucket's only at 120. Let me get that to 140. I'm going to rip that out in a year's time.
And it is important to note on when we talk about this stuff, we can land in this camp of all or nothing. And as an example, if you did say, all right, I'm going to set up a separate super fund, which I don't mind this idea just for the emotional quarantine thing. Like there's really, leave it in this, like I like the idea of, this super fund here, if there's husband and wife, they've each got 2 super funds.
Yeah.
One's for the mortgage savings, one's for accumulation.
One's their retirement one and one's their mortgage.
So onto the second super fund, it's okay if you're 50 years old and you commence this strategy and we go, for the next 5 years, we're going to put it in a 70-30 portfolio or an 80-20. When we're 55, we're going to take a look at this. Just depending on where we're at, where things are at, we might then tweak that fund for the next 3 years, or you're 57 and you will retire at 60. We're going to now put any new contributions just in cash and keep. So, I mean, choose your own adventure with this stuff.
Yeah, lots of ways you can carve it up. But I think that's the theme of, if you've never looked at your statement, step one, go and have a look.
Yeah, but this is the whole underlying thing. If you are working with a financial advisor, you'll be able to probably have this in the one account and be managed.
And segmented.
And all that. So, look, that's all good. We'll take a break and we'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, we are back. We are not badder than ever. We're just bad as usual.
Yeah, standard bad,
Point 4, review insurance as costs rise. So what do we mean by that?
So often within your superannuation fund, you will have some insurances. You may have worked with an advisor to get personalised insurances, and we're not talking about house insurance or car insurance. We're about life insurance and income protection and TPD insurance within your super. Those policies can either be personalised or they're default group cover within your insurance provider. Either of those are typically, as you get older, the cost of that for a 52-year-old is more expensive than a 42-year-old. The cost for a 59-year-old is more than a 49-year-old. So it's important to, again, review those to make sure, do I have the right level of cover? If I'm keeping the same level of cover, if I've opted into my super fund to keep me at $1 million of life cover, the cost of that is likely going to increase every year. Now, we haven't said cancel or reduce them. We're just saying review them because it may be that, I signed up to that. It was only costing me $300 a year, but now it's costing me $3,000 a year. That's going to impact how much money I've got into super. And so at that point, I would then, let's get some advice before we go and make any big changes, but at least review what we've got.
You know, they say if you're going to have a run at the king, make sure you don't miss. I'm going to have a run at the king. I think this slide, it shouldn't be called review insurances as costs rise. It should be called review insurances as circumstances change. Because you still may have a butt ton of debt, you still may have a butt ton of dependents, and you still have a need for insurance. However, the costs have risen. Well, got to suck that up. Still need it.
Yeah.
So I think it is more just that. And a couple of episodes back, we did a full episode with Phil Thompson from Sky Wealth about when to cancel insurances and all that. But I would also say each year is just some general housekeeping. We just run our eyes over stuff. Now, the life insurance and income insurance is different than your contents insurance at home, because if you've got a medical condition and you've got insurance for it, you're not changing your policy every 10 minutes, but you may change your home insurance or your content insurance. But that's, again, a general hygiene thing for anyone listening to the podcast, because you want to effectively, review your budget, review your expenses. But yeah, I really think in your 50s, there is a higher shot of, maybe the mortgage is significantly less. Maybe the kids have left home. Maybe you just still want a couple of $100,000 of death cover just because.
And the reason the cost is higher is because you're more likely to claim, whether you like it or not. But a 56-year-old is more likely to claim than a 26-year-old. So that's why the level of cover still needs to be there. Not that we're looking to seek out claim, but that's why the protection's there. And then also, without getting too much down into the weeds, but I agree, it's definitely not a just cancel. It's, okay, I need this cover. Maybe I do have to start salary sacrificing to cover the premiums more. Before, maybe my work contributions covered most of them, but maybe now they're not. So if I want to keep this cover, I need to keep affording it. And or if you're in what it's called like unitized insurance policies, you might look and go, oh, well, mine's actually not going down. My cost is not going down. But what they're actually doing behind the scenes is your level of cover is going down.
Yeah, so the cost is pegged.
They're keeping the cost at $300 a year, but you were last year insured for $300,000. Now you're only insured for $180,000. You might still want the $300.
Yeah.
Therefore, it's review it and contact your super fund and say, hey, I'm happy to pay a bit more because I need to keep this level of cover.
Yeah. Anyway, have a listen to the insurance episode if you haven't, but that's boring. Let's move along. Ooh, number 5. You've come in with a banger. Fifth and final point.
I had to wedge the insurance in there somewhere. But yes, they're coming back to the... So
it is important. I mean, you talk to any of our clients who have had to claim. I'm still... Last week I had a phone call with a client that I set up in 2013 and they had to claim on their insurance.
Well, yeah.
So 100% we see the value of it, and it's not an all or nothing. It's review and get advice.
Yeah. So number 5... Start building a retirement vision.
Ooh, I like when you talk dirty to me.
Now we're doing this forward looking. And it might be as simple as, you may already know this in your mind, or on your drive to work every day, you're dreaming about this day of retirement. But for many people, it's not, I've been busy, I've been achieving this in my career, I've been raising the kids, or I've woken up and all of a sudden I'm 53. I haven't thought about retirement. The person at 3 desks down just retired. Geez, when's that on my horizon? So when do we want to retire? What does that look like? Are we under control with the house and the mortgage? Do we have a plan or a vision around, am I retiring? Are myself and my partner the same age? Are we going to retire at the same time? If these are an age difference, but we still want to retire at the same time. Does my career allow me to go for as long as I'm planning or wanting to? So start to put some thinking to that. There's tools out there that help you do that, but often it's just sitting down and mapping through some of those questions that we just kind of rattled off there. And then as part of that, you will then start to work through, what do I need per year? Do I want to travel? Am I buying a caravan? Do we need to clear the mortgage still? And then start to working through the financial side of it. I think it's important to know the lifestyle side and then start to work through the financial side of going, well, am I on track for that or not? Is that a realistic target? And then fortunately, there are some DIY online calculators, but usually that might be the time to have a chat with an advisor or get some professional advice of going, I've done some deep diving. I think this is what we want to achieve. Are we on track for that or not? Or what do we need to do to make that work?
Your point about discuss your vision with your partner, it's a joint decision. It needs to be what is our retirement vision. But, and we've seen this pop up before, it can be really problematic if there is a relationship and one partner's 15 years senior. Now, one partner's 15 years senior might want to, I remember there was actually a question, we did talk about it. They wanted to, go and sail the world or caravan Australia. And the other one's like, I'm 45. I'm in my peak career.
Yeah, I'm enjoying my career and what I'm doing.
Yeah, but the older one was ready to. So you want to have those discussions pretty early because it's not let's get on the same page. It's knowing what page the other person is on as a good start.
Yeah, I mean, the lifestyle side and in turn then the financial side, because one of you may be 67 and eligible for the age pension, the other's not. So how does it impact your finances? I know one might be 65 and can access super and one's 58 and can't access super. So does that mean that the 58-year-old is working for 2 more years when the older one is already retired? Probably not practical unless they want to sit at home and twiddle their thumbs. And sometimes that is the case, working with clients that one will happily retire early and help with the kids or the grandkids or be busy while the other partner's still working. But generally it's kind of aligning those at a pretty similar time frame and then in turn making sure the financials allow that to happen.
Yeah. Any other final points on, start your retirement vision?
I think that's the case. I think it's lifestyle first, financial side. There are lots of unknowns. Your career, sometimes it's the case of, well, I'm going to work to 62, but at 58, my job's been made redundant. How does that impact me? Do I start a new career? Do I have to pull things forward? It might be, if I'm in my 50s, late 50s, how old are mum and dad? Maybe they're in their late 70s or early 80s. So are they going to need my help? I've gone from the younger dependents, the teenagers have grown up and moved out of home, but now I've got dependents above me that are going to start to need some help. That might be a time impact in a positive way. We want to look after family. It might be, well, now I can't work the 5 days anymore because I'm doing that. And so it may be a part-time and change as well. So it's a journey and things will change along the way, but adapting and I suppose having some direction is a part of that.
In finishing, I've probably got a couple of other things just to have people think about, not directly involved with money, but really important for your 50s. As we know, as time goes on, there's a chance of us getting older and ill. As a general PSA, particularly for the fellas, if you haven't been to a doctor, go and see your GP. As a PSA, get a PSA. Go get a simple blood test. Be guided by your doctor. They might have to put a glove on, like welcome to life. But you'd rather a bit of discomfort, do all the bowel screening. Like if you have not been to your GP in over 12 months, anyone listening, please go and say, I'm me for 12 months. Can you check my blood pressure?
Check-up.
Can you zap some bloods?
Yep.
I don't know, like family history, heart attacks, all that. Because if you don't and something goes down, the money stuff's out the window anyway. So get in front of this stuff.
And connecting back to the insurance side, particularly important that as well. Before we go and cancel and make any big changes, because if we cancel that insurance and, can I get that back? No, you cancelled that a year ago now.
So go do the health checks first before you start dicking around with your insurances. And then my other comments were in the back of your head, and we probably will talk about it more in the next episode, Money in Our 60s, but just what's your parents' situation? Are they in their 80s? Are they in good health? Do we have to, in the back of our mind, need to start thinking about, oh, yeah, mum was in a aged care home and, or her mum was or whatever, and like just some plan, like just in the back of your mind. We're not saying you pay for it, but just be aware, do we have to downsize mum or dad into another place? All that stuff. So a recap of our tips for money in your 50s. Stop making extra repayments off your mortgage. Superverse Mortgage, and we've got some slides that we went through. We want to make sure we top up concessional contributions. It's a really powerful way to boost super in the time leading up to access in terms of the tax strategy. Make sure your investments are in line with your preferences. Remember, if you're in your 50s now, it's probably going to be at least 10 years before you can touch that money. So let's put that money to work. Run your eyes over your insurances and what is the vision for your retirement life with your spouse.
It's an exciting time to be alive.
I wouldn't know. I'm not there yet.
Likewise. But we'll be there one day.
Hope so. My name's Glen James. This is
Martin McGrath.
And stay tuned next episode for Money in Your 60s. Hey, if you found this episode beneficial, could you do us a favour and forward the episode to someone that you know in their 50s? That's what we want to do. We want to get this word out there unashamedly. I want to grow the Retire Right podcast because I think we're doing a good thing here.
Help more people.
And we just want to help as many people as possible. And we can't do it without your feedback in the Retire Right Facebook group. If you do want to join the Retire Right Facebook group, just put where it asks, where did you hear about the group? Please put episode 3, insert episode number here, or make it very clear that you heard Glen and Martin on the podcast, because that way we know you're not a fake spam account. We'll see you next time. Thanks, friends. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.